Imagine waking up to realize that your retirement account has just become one of the primary backers of a company losing $5 billion a year, and you didn't even have a choice in the matter. Elon Musk is currently orchestrating what will be the largest initial public offering in human history, aiming for a staggering $1.75 trillion valuation. To understand the scale of this, at that price, SpaceX would be worth more than every single American defense contractor combined. It would exceed the combined market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks. While the public sees a revolutionary rocket company, the financial reality hidden beneath the surface is a complex three-layered business structure where the math simply doesn't add up for a traditional investor. The first layer is the one everyone knows, the rocket business. This is the part of the company that launches satellites for the government, sends cargo to the ISS, and conducts crewed missions for NASA. It generated roughly $4 billion in revenue last year, which sounds impressive until you realize it represents only about a quarter of the company's total revenue and looks tiny against a $2 trillion valuation. Then there is the second layer, the true crown jewel, Starlink. Starlink is essentially Comcast in space, a satellite internet provider that has become the fastest-scaling telecom company in history, with over 10 million subscribers across 150 countries. In 2025 alone, Starlink brought in $11.4 billion, accounting for 61% of SpaceX's total revenue. Its efficiency is even more shocking, with profit margins jumping from 41% to 63% in just 2 years. Between the rockets and Starlink, the company generated $8 billion in profits. However, the third layer is where the story turns ugly. In a move that remains financially baffling, SpaceX recently acquired xAI, Musk's AI lab, in an all-stock deal that valued the AI entity at $250 billion. This is a company that estimates only $1 billion in revenue but is burning over $1 billion every single month. Even more concerning is that by early 2025, every single one of xAI's 11 original co-founders had walked out, and Musk himself admitted the company needs to be rebuilt from the foundations up. Effectively, SpaceX paid $250 billion for an asset that currently functions as a reverse Jerome Powell, burning through all the cash that the rocket and Starlink divisions work so hard to generate. Because of xAI, the consolidated SpaceX entity actually lost nearly $5 billion last year, despite its massive revenue. The mystery then becomes, who would buy into a company with these fundamentals at such a record-breaking valuation? The answer lies in how the financial system is quietly changing its rules to accommodate this IPO. On May 1st, NASDAQ adopted a fast entry rule that appears tailor-made for SpaceX. Under the old regulations, a newly listed company had to wait 3 months for the market to discover its actual price before it could be added to the NASDAQ 100 index. This new rule compresses that 3-month period into just 15 trading days, meaning passive index funds will be forced to buy the stock almost immediately after it goes public. Furthermore, NASDAQ eliminated the requirement that a company must have at least 10% of its shares available for public trading. SpaceX is reportedly targeting a tiny free float of only 4% to 5%, a level that would have been an automatic disqualification just 6 months ago. Most confusingly, a hidden multiplier has been introduced where, for companies with a float under 20%, the index will treat that float as if it were 3 times larger than it actually is for weighting purposes. This means a 5% float is treated as 15%, legally requiring ETFs and index funds to buy significantly more stock than the actual market availability would suggest. This is not just about institutional investors. The CFO of SpaceX has explicitly stated that retail investors are a critical part of this IPO, with a target allocation of 30%, 3 to 6 times higher than a standard offering. The justification given is loyalty to Elon Musk. But in corporate terms, this looks like a plan to dump a massive supply of overvalued stock onto everyday buyers and retirement accounts. As some portfolio managers have warned, your 401k is being positioned as the exit liquidity for insiders who are sitting on a very low-cost basis. Because of the way passive investing works, if you own a standard U.S. stock index fund, you will likely become a SpaceX shareholder within weeks of the listing without ever casting a vote or making a conscious choice. The convenience of set it and forget it investing is being used to guarantee a buyer for a company that has managed to squeeze its way into the index through rewritten rules.